I do want to start off there with the expectations, economic expectations, if you will, and whether we, and I'm just using the royal we here, maybe got a little bit too dour about economic conditions.
I'm not sure we got too dour. Maybe we're losing our patience. What I would argue is that the move from 0 to 5% Fed funds in kind of a year has consequences. And we've seen a few of those with the financial accidents, but I suspect it will have consequences for an economic activity that slows very considerably sometime between now and the end of the year. As consumers retrench, as they run out of pandemic money, as businesses cut back a bit, we need to see some sloppiness in the labor market. We've seen some cracks, but probably not enough to get worried. But if that gives in too, the Fed will achieve its goal of slowing things down, and maybe they get too slow.
What are you focused on most right now? Because there's obviously been a lot of talk as of late, Bob, about the debt ceiling and a resolution to that, maybe potentially being that upward catalyst for the market. Other folks still point to the Fed and economic conditions as sort of being the all-clear signal that they need. What are you watching most?
Well, all of the above, but I'll highlight earnings. And as you pointed out a minute ago, first quarter earnings have come in better than expected. Expectations were minus 5% coming into the quarter. Looks like they'll be minus 1%. So 4 points better than expected. But full year numbers haven't been raised, which means analysts have taken some numbers out of second, third, fourth quarter. That is the amount the companies beat in the first quarter just being taken out of the rest of the year, implying analysts are concerned their estimates are probably still a little too high.
Well, so Bob, then how much is this market trading on macro conditions versus individual valuations?
Yeah, I mean, you look at your screen, and when you see, at least when I see my trailing PE over 20 and my forward PE on numbers that I think are still too high, approaching 19 times, I say, boy, a lot has to go right to justify those kind of numbers with interest rates where they are. So I'm a bit on the cautious side. Look, we paid the piper last year. It was a nasty bear market, and I think the Bulls and the Bears will both be frustrated this year, but we're toward the higher end of the trading range. I'd be a little cautious here.
Well, so there's so much event risk between now and the end of the year, between now and the end of June with the debt limit. But if some of the things go right, so if we get some kind of resolution to the debt limit, and if, you know, El Nino doesn't pan out to be as bad as it might be, for example, do we then see a drop-off in valuations for other reasons?
It's possible. I come back to the earnings. If the earnings come through better than expected, as they did in the first quarter, markets should be just fine. That would mean no recession, no noticeable slowdown. But I think with the leading economic indicators down 12 months in a row, the inverted yield curve, negative money growth, these are foretelling an economy that's going to slow and probably lead to a recession. We just don't know the lag time from Fed raising rates to when this hits.
Is there any sense here that, based on what we know now, Bob, that there are opportunities to reallocate and reposition, or is this sort of a stand pat and wait to see what happens?
Well, man, I think absolutely. There's always stuff going on inside the market, and as you've been reporting, the volatility day-to-day S&P has been almost zero. So what's happening inside the market? Well, look at today. It's great to see the bank stocks leading the parade, energy not far behind. These are sectors that have been left with the uncertainty dust, if you will, as people have rushed to these, quote, higher dependability kinds of names like big tech. They're up today, but nothing like the banks and the energy stocks. So inside the portfolio, there's always plenty to do.
Is there more to go with these bank stocks, Bob? I mean, yes, we're seeing Comerica up more than 10%, Zion's up, you know, close to that. But at the same time, many of these stocks are down multiple percentage points, you know, as much as 77 for a couple of the banks. So is there more to go there?
Yeah, this rally you'll hardly see on a chart after the big decline you point out. But when WAL yesterday said, you know, deposits are coming back in, I think that's caused a lot of investors to breathe a bit of a sigh of relief, and that's why those bank stocks have run. I don't think their run to the upside's over, but I'm also going to not say it's all clear and there are no more financial problems. I come back to 0 to 5% Fed funds in a year has consequences.